Deferred annuities. When it comes to the accumulation and distribution of funds, there are two types of annuities. Immediate annuities, purchased with a single payment, called a premium. These begin distributing annuity payments almost immediately. Deferred annuities, purchased with either a single premium or through periodic premiums. These accumulate funds for possible annuitization at a future date. Immediate annuities. An immediate annuity is purchased for distribution purposes only. A person who buys an immediate annuity exchanges a single large premium for an immediate stream of income. The duration of the income stream depends on the annuity payment settlement option selected by the owner. The payment amount depends on the premium amount and the payment option selected. Because they are purchased with a single payment, immediate annuities are also called single premium immediate annuities, or SPIAS. Key point. An immediate annuity begins payments at the end, not the start, of the first payment cycle. For example, if periodic payments are to be received monthly, then the first payment is received 1 month after purchase. If payments are to be received annually, the first payment is made 12 months after purchase. Deferred annuities. A deferred annuity is an accumulation contract. Annuitization, if it occurs at all, is delayed until a future date. During the accumulation period, funds grow on a tax-deferred basis. Deferred annuity premium payment options. Deferred annuities may be funded under one of several premium options. Single premium deferred annuity. A deferred annuity can be purchased with a single lump sum payment. Once a single premium deferred annuity, SPDA, is purchased, no additional premium payments are accepted. Fixed premium deferred annuity. Originally, all deferred annuities that were not SPDAs were funded with fixed, level premiums of a specified amount. Much like whole life insurance requires fixed premiums. These fixed premium deferred annuities, also called retirement annuities, specify the exact premium amount that must be paid, on a scheduled basis, for the contract value to grow to the amount needed to produce the desired income payment amount upon annuitization. Fixed premium deferred annuities are still available for those seeking a specific amount of future income. Flexible premium deferred annuity. Annuity buyers today generally prefer flexible premium deferred annuities, which allow owners to make premium deposits of any amount at any time. Insurers may impose minimum premium amount requirements. Key point. Accumulated funds in a deferred annuity are non-forfeitable. They belong to the annuity owner always, even if the owner stops making premium payments. Deferred annuity values can be fully or partially annuitized at a future date, or they can be withdrawn periodically, in full or in part, at the owner's discretion. Deferred annuity surrender charges. While deferred annuity owners are always fully vested in their contract values, they may be required to pay a surrender charge for withdrawals made within a specified period following the annuity purchase date. The surrender charge is typically a declining percentage of the withdrawn amount. For example, a deferred annuity's surrender charge schedule may be 7% of the amount withdrawn during the first 3 contract years, 5% of the amount withdrawn during the 4th through 6th contract year, 3% of the amount withdrawn during the 7th through 10th contract year, 0% beyond the 10th contract year. The length of the surrender charge period varies by insurer and contract design, and may be longer than 10 years. Once it has ended, no charges are imposed on future withdrawals or surrenders. Bailout provision. Some deferred annuities include a bailout provision, sometimes called a waiver of penalties provision, that allows charge-free withdrawals if the interest rate credited to the accumulated value drops below a specified level. Some deferred annuities permit the contract owner to withdraw funds from the contract at any time, without a surrender charge, if the owner becomes terminally ill or requires long-term nursing care. These are sometimes called medical bailout provisions. Deferred annuity death benefits. If a deferred annuity owner or the designated annuitant dies during the contract's accumulation stage, the contract's cash value is paid to the beneficiary as a death benefit. Owner-driven contracts pay the death benefit if the owner dies, while annuitant-driven contracts pay the death benefit if the annuitant dies. For your review, A person who buys an immediate annuity exchanges a lump sum amount of money for a stream of income in the form of periodic payments. A deferred annuity is an accumulation product that may be funded either with a single premium, SPDA, or with periodic flexible premiums. Deferred annuities may be fully annuitized at a future date, or the owner may simply withdraw funds at will. Surrender charges may be applied to withdrawals within the first 10 years or so of purchasing a deferred annuity. A bailout provision lets deferred annuity owners withdraw funds without a surrender charge if the interest rate falls below a specified level. Owner-driven contracts pay the death benefit if the owner dies, while annuitant-driven contracts pay the death benefit if the annuitant dies. Please pause the audio and watch the video.
Remember that the fundamental purpose for an annuity is really its core reason for being is to distribute a sum of money. All annuities include a provision on how that money can be paid out. There are annuity payment options available to the annuitant that basically provide a number of different ways that that money can be paid out. The distinguishing feature that separates one type of annuity from another is how that money gets into the annuity in the first place. And for that, the lesson describes deferred annuities and immediate annuities. We want to make sure we understand some of the subtle distinctions between the two. And I'm going to do that by really focusing on the deferred annuity. Originally, a deferred annuity had to be annuitized. In the very beginning, annuity owners had no choice but to own a deferred annuity, put money into it, and eventually distribute that money through the form of lifetime payments. Over the years, deferred annuities have evolved into attractive accumulation instruments, but it's important to use the deferred annuity for its long-term intended purpose of, again, long-term accumulation. And that's because there are several things that discourage the use of a deferred annuity for short-term purposes. Number one, unlike life insurance, we noted in a separate lesson, where there is the ability to take out the cash value on a tax favorable basis, distributions from a deferred annuity are taxable right up front. It is what we call the last in, first out principle, where the earnings are the first money to be considered distributed and therefore are taxed. Furthermore, distributions from a deferred annuity before age 59 and a half are subject to an additional 10% penalty tax. So between the taxation of the distribution and the 10% penalty tax, taking money out of a deferred annuity can be a costly proposition. What's more, virtually every deferred annuity has surrender charges that can extend for 7, 10, or even more years after the annuity is issued. So taking money out of a deferred annuity can, again, be a very costly proposition. The last thing I want to emphasize with deferred annuities is there's been a lot of regulatory focus on the use of deferred annuities, the sale of deferred annuities in the senior market. The concerns are really what I was just talking about, the fact that there can be taxable consequences involved with withdrawing money from a deferred annuity and the surrender charge. If a deferred annuity is purchased by a senior, the question then immediately becomes, what is the purpose for buying that annuity? If it's simply to hold the money as an accumulation vehicle, is that senior going to be hit with taxes and surrender charges because they take that money out, if you will, before their life expectancy? So when you study deferred annuities, keep in mind that their use in the senior market is under close observation by regulators, and frankly, probably doesn't make a lot of sense in a lot of situations.
Okay, so here is our 4 questions for this lesson. Alice deferred annuity imposed a declining surrender charge that begins at 7% during the first year of the contract and declines 1% point each year. What will be the surrender charge rate for a full withdrawal? The third year of the contract. I'm guessing 1 percentage point each year. Declines 1% each point. So we'll say 4, right? Because it's going down 3. What must an annuity owner do to withdraw funds from his or her annuity contract? I want to say provide proof of owner's needs. Which of the following annuity specifies the exact premium payment amounts for the contract to generate the desired future income payments? Flexible premium. What does the length of an annuity surrender charge period depend upon? It depends on the age of the beneficiary, the period selected, the age of the annuitant, the contract design. I want to say the contract design. And we only got one right, as usual. This is not unusual for me. I'm going to do these live eventually. So if anybody wants to see these done live so you all can help me answer the questions, then please comment in below. If I don't get any comments, then I won't do them live. Okay. So the first one is 5%. So it only went down 2. The first year is 7, then it goes down 6 the second year, and then 5 the third. All right, what must an annuity owner do to withdraw funds? Notify the insurer of the request to withdraw funds. The third one is a flexible premium deferred annuity. So instead of a fixed premium, it's a flexible premium. This allows the owners to make premium deposits on the amount that he or she wants. And the last one is the contract design, which I got correct, the length of an annuity surrender charge. This period depends upon the contract designed. Okay, so if you're interested in more annuity, the next one will be annuity settlement options, and we will do this on the next video. Thanks, everybody.